All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. How you doing? You're in LA, right?
I am. I had a little trip to the East Coast this past month, but I'm back in sunny California. How are you doing?
Good, good. Final day. It's always quiet. Trading volumes this week are, other than the week after Christmas, this is the latest trading volume of the year, trading volume week of the year. And the markets held up very, very well. August is a very choppy month, but overall, pretty good.
Great. Well, it'll be interesting to see what the end of the year brings. But let's start there, Bob. So where do stocks stand now as August comes to an end?
Well, the bad news, I'll get out of the way, is we're in the seasonally weak period. August, September, October, the worst month of the weakest 3 months part of the year. September is usually the worst month of the year. It's usually volatile. October can be messy too, but historically, September is the worst month for the Dow, the S&P, the NASDAQ, even the Russell. But August was never a very great month, particularly either. So that's the bad news. The other tough situation is the election. Just very hard to figure out what's going to happen there. There are a lot of traders who think that the outcome is not going to be known for some time after the November 5th election. The outcome will not be known that night. Maybe it will, maybe it won't. But if it's not, that adds another layer of uncertainty, what is normally a seasonally strong period. November usually starts a seasonally strong period. So that's the bad news, this seasonal weakness and the election. But the good news, I think, outweighs the bad news. I have been fairly bullish on the near-term outlook. Near-term means like the next 6 months. Number one, inflation has been waning. The numbers are good. We got the PCE, the personal consumption expenditures numbers this morning. They were good. That's the most important thing. Because of that, the Federal Reserve is in a easing mode. How much we don't know, but they made it very clear they're more concerned about the job market slowing down. And the job market is slowing down, but not much. So that's good. Inflation's waning. The Fed is in easing mode. The earnings situation is really strong. Nvidia was like the last company to report in the second quarter, and their numbers were not bad. And the important thing is the overall S&P 500 earnings were up 13% in the second quarter. That's really good. The estimates early on were 9 or 10%. So it was, better than people expected. It usually is a little bit. Third quarter numbers are maybe 7% on the upside for the S&P. Fourth quarter is 13% again. So the bottom line is earnings are going to be up about 10% on the overall S&P. And that's what drives the stock market. That's what drives the S&P by and large. And the estimates for 2025 earnings are up 15% or so. So you have inflation waning. You have the earnings still strong. You have the Fed in cutting mode. And then you have the stock market. The market's broadening out. This word broadening means that for the first half of the year, tech stocks dominated everything. In August, that's not happening. Tech stocks are kind of flattish in August. Instead, we're seeing real estate, utilities. These are interest rate sensitive, do a little bit better. Parts of banking, bank stocks are doing better. Industrials are doing a little bit better. Consumer staples. That's a broad market outlook, and that's good. You don't want just tech stocks dominating things. So the best news that I have is the Fed. And the Fed has implied they're going to be very vigilant if the job market deteriorates. Remember, the Fed has two obligations. One is to try to keep inflation under control, and the other is to try to keep the job market strong. It's a dual mandate. Well, they've been concerned with inflation getting out of control, and they should be for the last couple of years. That was the right thing to do. But now they feel they're winning that war, and they can turn more to the job market. The job market's still been strong, but it's not as strong as it was, which is fine, actually. But they'll be very hyper-vigilant. So let me put it to you simply. The Fed has implied they'll get very aggressive if the job market deteriorates. Now, what does that mean? It means that if something really happens in the job market, instead of a 25 basis point cut, the Fed's going to cut 50 basis points. In other words, there's kind of a Fed put in the market. If things deteriorate, the Fed's going to be there, and they've already implied that. To me, that's the single best thing about what's happening in the stock market right now. But everything else is still positive, too, other than the fact that we're in the seasonally weak period. So listen to what I've been saying. Overall, this is a reason to be reasonably bullish going into the fourth quarter.
So, Bob, you mentioned Nvidia's earnings results. You said they weren't bad, but how did Wall Street react to Nvidia earnings?
I did a whole story on Trader Talk, and a lot of people kind of gave me a lot of attitude for it. My position is nobody is doubting that the AI story is real. Nobody is doubting that AI is becoming more and more important. Nobody doubts that AI is going to be a growth story. The issue is how much are you willing to pay for it? That's the issue. And that Wall Street always grapples with that. Stocks do not go to the sky, not even Nvidia. Just because Nvidia is up 160% this year, do not make the mistake of thinking that Nvidia is going to be up 160% in the next 12 months. That would be very bad thinking. That would be an incorrect way to look at the market. The past price performance does not indicate future price performance. It never did. We put these numbers up for historical reference and to show you as an investor how you're doing. It doesn't mean that the future is going to look like the past. Don't ever make that mistake. So the question becomes, now that Nvidia's had this explosive move up and the earnings have gone up too, does that mean it's going to keep going up? And the question is, what does the earnings look like? So here's what I said. I said, number one, the earnings for Nvidia are still growing, but the rate of growth is slowing. And that's very, very important. The rate of growth. It's not just that earnings are going up. It's how fast are they going up compared to where they were going up. And it's slowing. That's number one. The secondly is, if you look at the amount that they're beating, Wall Street plays this game. What's the earnings going to be like? And Nvidia just blew the numbers apart in the last year and a half. I mean, they were like amazingly big beats. And now the beats are getting much, much smaller. This time they were only like 4% beat. Last time it was beat by 10%, and then larger in the months, in the quarters before. Well, this tells you Wall Street's getting hip to this game. Analysts are getting better at estimating what Nvidia's earnings are doing. So less surprise on Wall Street. The third is because the prices are still rising as the earnings growth still goes up, but it's decelerating. The multiple is rising. How much? A multiple is a PE ratio. A multiple just says, how much am I willing to pay for a future stream of earnings? And when the multiple keeps going up, it means you're paying more and more for a future stream. Be careful there. So these three things are warning signs. One, earnings still growing but decelerating. Two, earnings beats getting smaller. And three, the multiple is going up. That doesn't mean that the stock can't go up. It just means you better be careful. That's what I'm saying. So the problem is that there's a lot of, I call it messianism, caught up around AI and around Nvidia. People think, oh my gosh, don't get in the way of our program here. It's almost like the way some people felt about Bitcoin. There's a lot of people who've gotten rich here on Nvidia, and they don't want anybody interfering with that game. And so let's get with the program here, Bob. We want Nvidia to keep going up, regardless of what the fundamentals are. And I'm sorry, the stock market doesn't work that way. You may not believe in gravity, but gravity very much believes in you. You may think that because Nvidia is up 160% this year, it's supposed to be up 160% in the next 12 months, but you would be making a very serious mistake about that. The laws of financial gravity have not been repealed, not by Nvidia, not by you, not by me, and not by anybody. Nvidia is not divorced from the laws of financial gravity. And it has had a spectacular move. It is one for the record books. It is an anomaly, but it is not immune from the laws of financial gravity. So look at the reaction this week. It still had good earnings, but did it do much? No, the market didn't push Nvidia up like it did all these quarters before. That's a sign. So what I said there on the fundamentals is absolutely the case here. That's all I'm saying.
All right, Bob. Our next question is about big concentrations in tech companies. So how can we protect ourselves from huge concentrations in tech?
Well, look, you stay diversified. There's nothing wrong with owning the S&P 500. There really is not. Now you can say, wait a minute, 30% or 32% of the S&P 500 is technology stocks. That's a high. That is a high level of concentration historically. Yes, that's true. But does that mean you should take some action? I'm not sure. The thing about market cap weighted indexes is it's a popularity contest. This is what the world collectively thinks certain stocks are worth. And for whatever reason, I think there's good reason, the world is valuing Apple and Nvidia very, very highly. And I think they're right about that. I don't think that's irrational at all. But I don't have a problem. The S&P is a diversified index. It really is. Now, you can say it's a little over-concentrated in tech, but there has been over-concentrations in the past. Now, that doesn't mean that, if tech gets under pressure, fine. Tech was under a little pressure this month. But overall, the S&P is still up this month because you get broadening out. So diversification is the way to avoid concentrations. What you want to be careful of is suddenly if 90% of your portfolio is the S&P technology index or the triple Qs, the NASDAQ 100, that's dangerous. I'd be very careful about that. So I have been very public in what I own. I'm one of the few people out there that's a financial journalist that has published what I own. I did it in my book, Shut Up and Keep Talking, which came out almost 2 years ago. And there's a whole chapter in my history of what I own. And you should not be surprised that I own mostly index funds. I own S&P 500 index fund as my largest holding, but I also own small cap value fund. I also own a mid cap index fund. I also own a very broad bond fund. Happens to be a Vanguard fund, but it doesn't matter. And I also own an international fund. I finally own a money market fund where I have maybe 5% in a money market fund, which has done very well because money market funds are doing 4 or 5%. So that's what a diversified portfolio looks like using ETFs and index funds. S&P 500 ETF is your core holding. You own a small cap fund. I happen to own a small cap value fund because I still think value will have periods of outperformance. I own a mid-cap index fund, so you capture a lot of mid-cap stuff, airlines and things like that. And I have an international fund. And in fixed income, I have a money market fund, and I have a very broad bond fund. Now, the percentages you use in all that depends on your risk profile. In my case, and I've said this in the book, I'm still probably at almost 70 years old, close to 75% invested in stocks. Maybe it's 72%, somewhere around there. But, if you want to talk about the traditional 60-40 split, I have a higher profile in stocks because I always have, because I'm the stocks correspondent for CNBC. So I have a little bit of a mental bias towards stocks. But I'll tell you how I think, and I've said this before, I'm almost 70. I'm planning to live to at least 90. That means I have 20 more years. That means even if this year is a flat year, it's not going to matter this much. Remember, in 2022, the S&P was down 18%. That's like a distant memory now. And yet that was such a catastrophe. Everyone was saying, oh my God, I'm going to get out. So I would tell people that the way to deal with this, to protect yourself from concentration, is do what I just did and showed you. And you can take a look at my book if you want. And know what your risk tolerance is. Know how old you are. Know how much you want to invest. What percentage you're comfortable investing in stocks versus bonds versus owning real estate. But be diversified. It's too risky to put all your money. And then I talk to people all the time. Oh, I'm diversified. I own 10 stocks. That is not diversification at all. That is way, way too risky. In fact, my personal opinion for years, this is my personal opinion, owning individual stocks is very, very risky. It exposes you to too much problems. Look how fast some of these stocks will move, 15, 20% on their earnings. You want to be exposed to that? I think that's kind of risky. But some people like to take risks overall. So to answer your question, protecting yourself from huge concentration in tech, own broadly diversified indexes.
Yeah, I think that's definitely helpful for everyone, Bob. So our last question today is one that comes up pretty often, but how can investors prepare for a recession?
Well, first off, I don't think a recession is imminent. So just remember something. In October 2022, we were all convinced, everyone, that a recession was imminent. What happened? Nothing. Wrong. The Fed was wrong. The Fed's estimates of inflation were wrong. I mean, way off. Market prognostication is a terrible business. Most people suck at predicting the future. And I mean, not just amateur stock investors suck at figuring out where the stock market's going. Professional investors suck at figuring out where the stock market's going or the economy. Professional strategists on Wall Street who are paid to sit and talk by big houses are terrible. The Federal Reserve is terrible at predicting GDP and inflation 1 year out. And they have admitted it. If you listen to Jerome Powell, he said we have a lot to be humble about when it comes to our prediction. He said that recently. So what does this tell you? Everybody's bad at this. Why? Well, there's various reasons. I discuss it in my book, but it has to do with a lot of mental biases that people have and the fact that the data is so complex that the future is largely unknowable. So you prepare by being broadly diversified. And if you're a long-term investor, you should be. The answer to the question, how do I kind of prepare for a recession, is nothing. Recessions are not a reason to alter an investment plan. Recessions are a normal part of the U.S. economy, and they have been for the entire history of the U.S. economy. If you are a lot older, say you're my age, and there are certain circumstances, and again, you would always should talk to a professional about this, but the professors will tell you if you're older and you suddenly need a substantial sum of your retirement in the next few years, and you think the market is somehow going to be down substantially in the next few years, then you might want to reduce your exposure. That's what you would do. However, that's a lot of ifs. If you suddenly need a lot of your money in the next couple of years, and if you think the market is going to tank dramatically, all right, but that's a lot of ifs. That's highly unlikely. The stock market, the S&P goes up 3 out of 4 years. A year when it's down 18% is actually extraordinarily rare. Extraordinarily rare. We've regained all the losses that we had from 2 years ago. So I would simply have a plan and stick to it. And just because there is a recession, you think that you would know, oh my gosh, there's a recession coming and I'm going to sell. Well, what would have happened in October 2022 when everyone believed there was a recession and you would have pulled out of the market? That would have been a fairly stupid thing to do. And we know that in history. And yet people still keep reacting viscerally to things that are going on. Just believe in the U.S. economy, have a long-term plan. If you're not comfortable, if you can't sleep at night owning stocks, then don't own stocks. But I would advise you that history has shown long-term, your best long-term investment is in the stock market. It doesn't mean the stock market outperforms every year. There are years when owning bonds would do better for you, which is why you have a diversified portfolio. The last 15 years, that has certainly not been the case, though. The stock market is far and away the better investment. So you don't know what's going to happen. Therefore, diversification is the logical choice for anyone who freely admits they're not sure what's going on. That's what I do, Katie. I hope that's what everybody else will be doing.
Thanks, Bob. And that's our last question for today. So thank you to everyone who sent in questions. Feel free to leave a comment wherever you're watching this if you have questions for next time. And we'll talk to you again in a couple weeks.
Thanks, Katie. Good questions, everybody. Have a good weekend.